Starting an LLC or corporation in the U.S. offers many advantages, one of which is the ability to take advantage of specific tax strategies. One key benefit often discussed is the potential to receive profits through distributions, which can be taxed at a lower rate than wages. Understanding how this works can help you manage your tax liability more effectively. Let's clarify what these distributions are. When you operate an S corporation or LLC electing S election, profits left after paying yourself a reasonable salary can be taken as distributions. These are portions of the company's earnings passed directly to the owners or shareholders. The main advantage, unlike wages, distributions aren't considered employment income, meaning they aren't subject to payroll taxes such as Social Security and Medicare taxes. But before you start withdrawing distributions, IRS rules require that you pay yourself a fair, reasonable salary for your work first. This is to prevent underpayment of employment taxes. The challenge is that reasonable can be somewhat flexible, varying with industry norms and your role. To avoid issues, it's best to pay yourself a wage comparable to what someone else with similar experience might earn in your area. Once that is settled, distributions become accessible. They're usually proportional to your ownership stake, meaning if you own 25%, you'd receive 25% of the profits distributed. These distributions are taxed differently. They're subject to income tax, but not payroll taxes, which can lead to significant savings. However, the IRS watches these allocations closely. Paying yourself a salary that's too low and taking larger distributions could trigger scrutiny. If caught, the IRS can reclassify distributions as wages, resulting in back taxes and penalties. So, don't see distributions as a way to cheat taxes, but rather as a legitimate strategy when used correctly. The amount you can take as distributions isn't fixed. It depends heavily on your company's profitability and your ownership percentage. A practical approach involves paying yourself a reasonable salary first, then distributing remaining profits according to your ownership stake. Beware of the 60-40 rule sometimes mentioned, which suggests paying 60% of profits as salary and 40% as distributions. That's a rough heuristic, not an official rule. Really, your focus should be on paying a fair wage based on market standards. Reporting these distributions involves filing a Schedule K-1 along with your personal tax return, Form 1040. You'll report your salary on a W-2 and your distributions are noted on Schedule E. The formal tax filing for your business is done using Form 1120S if you've elected S corporation status. Here's an example. If you're a member of an LLC operating as an S Corp in a city like Austin and your share is 40% with annual profits of $500,000, then after paying yourself a reasonable salary, say $70,000, you could take out around $196,000 as distributions depending on actual profit and your ownership percentage. These are just ballpark numbers, but they illustrate how hiring a knowledgeable accountant can optimize your finances. If you're considering such arrangements, it's wise to carefully determine your fair industry standard salary first. Doing so ensures compliance and maximizes your benefits. Outsourcing these calculations to professionals can help you avoid mistakes that might cost more later. While this overview doesn't cover every scenario, the main takeaway is that with the right approach, distributions can be a valuable part of your tax strategy. Always make sure your compensation aligns with IRS guidelines, and if you'd like to explore how this might fit into your business plan, reaching out for expert advice is a smart next step. For more insights tailored to your situation, consider consulting a professional. You can contact Filing Fox at info@filingfox.com to get started on aligning your financial strategy with your business goals.